You check your mail on a Tuesday evening. Among the flyers and the utility bills, there is a crisp white envelope from your primary bank. You recognize the logo instantly. You have been a loyal customer for over a decade. You hold your mortgage with them, your checking account, your credit cards, perhaps even your children's savings accounts. You know your 5-year fixed mortgage term is coming up for renewal in a few months, so you assume this is the standard paperwork. In the past, when this was a cause for minor annoyance, nothing more. 5 years ago, when you last renewed, they sent you a simple letter with a new, slightly different interest rate and a single page asking for your signature. You signed it, mailed it back, and the machine kept turning. You expect the same routine today. You open the envelope, pull out the documents, and begin to read. But this is not a one-page auto-renewal form. This is a demand letter. The bank is not offering you a new rate. And they are asking you to prove that you still deserve to keep your house. They are demanding your most recent T4 slips. They are demanding your latest notice of assessment from the Canada Revenue Agency. They want 3 months of consecutive pay stubs. They want a signed, formalized letter of employment from your company's Human Resources Department, complete with a supervisor's contact number. And they give you a strict, unforgiving deadline to provide this documentation. If you fail to comply, or if the numbers on those documents do not meet their newly updated internal risk algorithms, the letter states clearly that your mortgage will not be renewed. The balance will be called in full. You stare at the paper, the reality of the situation slowly draining the color from your face. You have never missed a payment. You have never been late, but suddenly your own bank is treating you like a hostile liability. Welcome back to Canada Property Watch. Over the past few weeks, we have exposed the devastating traps laid out by the Canada Revenue Agency. We showed you how the exit tax strips your equity when you sell, how the death tax confiscates your legacy when you pass away, and how the $1 mistake triggers double taxation on your family. But while the government is waiting to tax your equity, the banks are executing a quiet, ruthless operation to ensure you do not have any equity left to tax. Today, we are investigating the most dangerous financial maneuver currently executing in the Canadian banking sector. It is a silent purge. We are exposing the T4 trap and explaining exactly why Canadian banks are suddenly demanding aggressive proof of income from their most loyal customers before renewal, and how this mechanism is being used to quietly trigger a wave of mortgage recalls and forced sales across the country. To understand why your bank has suddenly turned against you, we have to look back at the financial frenzy of 2020 and 2021. During that era of rock bottom, sub 2% interest rates, the Canadian real estate market experienced a euphoric, debt-fueled explosion. The banks were issuing mortgages as fast as their underwriters could approve the paperwork. In the rush to capture market share, the standards for income verification became dangerously loose. And this was the era of the Brampton loan, a colloquial term for mortgages secured through fraudulent income documents, fake T4s, and exaggerated employment letters. But it was not just outright fraud. It was also an era of extreme optimism. Borrowers were qualifying for massive loans based on the dual incomes of secure, high-paying white-collar jobs, supplemented by overtime, bonuses, and side hustles. The banks stress-tested these borrowers, but they stress-tested them against an economic reality that no longer exists. Fast forward to today, the financial landscape of Canada has violently fractured. As we documented in our investigation of the Great Layoff, the Canadian economy is hemorrhaging full-time, high-paying jobs. The tech sector, the financial sector, the manufacturing sector, and the corporate consulting layers have been gutted. Hundreds of thousands of Canadians who qualified for their mortgages 5 years ago as senior directors or regional managers are now unemployed, underemployed, working contract gigs, or driving for rideshare apps to make ends meet. They are burning through their savings and maxing out their lines of credit just to keep the monthly mortgage payments flowing. From the outside, their accounts look perfect. They have never missed a payment, but on the inside, they are financially hollowed out. They are running on fumes. The banks know this. The executives sitting in the glass towers in downtown Toronto are looking at their internal data, and the data is terrifying. They are looking at the massive surge in credit card debt. They are looking at the utilization rates of home equity lines of credit hitting absolute maximum capacity. They are looking at the rising cost of property taxes, insurance, and groceries. They know with absolute mathematical certainty and that a massive percentage of their mortgage portfolio is currently held by people who are technically insolvent. These borrowers are completely incapable of surviving the payment shock of renewing their mortgages at today's interest rates, which are significantly higher than the pandemic-era lows. But the banks have a problem. Under the traditional Canadian banking model, a mortgage renewal at the end of a 5-year term with the exact same lender was almost always automatic. And as long as you made your payments on time, the bank did not ask questions. They just rolled you over into a new term. This automatic renewal process shielded the banks from having to acknowledge the rotting foundation of their own loan books. If they didn't ask about your income, they didn't have to formally admit that you were unqualified, and they didn't have to classify your mortgage as a high-risk asset to the federal regulators. It was a policy of don't ask, don't tell, and it kept the Canadian housing bubble inflated for over a decade. That policy has now been terminated. The Office of the Superintendent of Financial Institutions, known as OSFI, the federal watchdog that regulates Canadian banks, has stepped in. OSFI has looked at the hundreds of billions of dollars in mortgages coming up for renewal in the next 24 months, and they have realized the systemic threat to the national economy. They have issued their stringent guidelines to the major financial institutions. OSFI is demanding that banks actively manage their risk. They are demanding that banks stop extending credit to borrowers who are structurally incapable of carrying the debt. The regulators have forced the banks to take the blindfolds off, and so the T4 trap was activated. The banks are no longer using the automatic renewal process as a default. Instead, they are deploying sophisticated or AI-driven risk algorithms to scan their entire portfolio of approaching renewals. This algorithm is searching for specific trigger events. It is looking for borrowers whose credit scores have quietly drifted downwards over the last 2 years. It is looking for checking accounts where the bi-weekly direct deposits from a recognized corporate employer suddenly stopped and were replaced by erratic, smaller deposits. And it is looking for customers who have been making only the minimum payments on their credit cards or who have entirely drained their savings accounts. It is looking for borrowers with fixed payment variable rate mortgages who hit their trigger rates and have been experiencing negative amortization, meaning their monthly payments are not even covering the interest and their total loan balance is actually growing every month. If your profile triggers enough of these red flags, the algorithm pulls your file out of the automatic renewal queue and drops it onto the desk of a specialized risk mitigation underwriter. You are no longer treated as a valued customer. You are now classified as a toxic asset. And the underwriter's job is to either verify that you can survive the coming payment shock or to purge you from the bank's balance sheet entirely. This brings us back to the letter you received in the mail. When the bank demands your T4, your Notice of Assessment, and your employment letter, they are executing a brutal, uncompromising stress test. They are not asking for these documents as a formality. They are putting your current real-time financial reality through the ringer of the gross debt service and total debt service ratios. Let us break down exactly how this trap closes on a typical Canadian family. Imagine a household that bought a suburban home 5 years ago for $900,000. Back then, the husband was earning $100,000 and the wife was earning $90,000. Their combined income of $190,000 easily qualified them for a massive mortgage at 1.9% interest. But 2 years ago, the husband's company downsized and he lost his corporate job. Despite sending out hundreds of resumes, the only work he could find was a contract position paying $60,000 a year. The family's combined income has dropped by $40,000. Through sheer willpower, strict budgeting, and relying on credit cards for groceries, they have managed to never miss a single mortgage payment. They thought they were safe because their payment history was flawless. Then the renewal letter arrives, demanding the income proof. They submit their current pay stubs and their latest tax returns. The underwriter plugs a lower income of $150,000 into the system. The system then calculates their new mortgage payment at today's current interest rate, which is dramatically higher than their old pandemic rate. The algorithm divides their new massive monthly housing cost by their newly reduced gross income. The result is catastrophic. Their gross debt service ratio blasts past the federal limit of 39%. The underwriter looks at the screen. The computer dictates that this family is mathematically guaranteed to default in the near future. The bank's internal policy, driven by OSFI regulations, prevents them from renewing a loan that wildly exceeds the risk parameters. The underwriter clicks a button and a second letter is generated and mailed to the family. This second letter is the realization of every homeowner's darkest nightmare. It is a formal notice of non-renewal. The bank informs you that based on your current financial profile, they are unwilling to extend a new mortgage term. They state that your entire remaining mortgage balance, perhaps $600,000 or $700,000, is due in full on the exact date your current term expires. You are given 30 to 60 days to pay off the bank, or they will initiate foreclosure or power of sale proceedings to seize and liquidate your home. You have just been hit with a mortgage recall. But the bank has fired you as a customer. The psychological devastation of this moment cannot be overstated. You played by the rules. You sacrificed everything to make the payments. You kept your end of the bargain, but the bank has unilaterally altered the terms of survival. They have looked at your financial bleeding and decided to amputate the limb rather than apply a bandage. When a family receives a non-renewal notice, panic sets in immediately. When the first instinct is to go to another major bank, a different A lender. You walk into a competing branch, explain your situation, and ask to transfer your mortgage. But the moment the new bank pulls your credit file and sees the exact same reduced income and the exact same maxed out credit cards, their algorithm spits out the exact same rejection. The major banking system operates as a unified cartel when it comes to risk assessment. If you are too toxic for one major bank, then you are too toxic for all of them. The clock is ticking. You are now weeks away from your renewal date. The original bank is preparing the legal paperwork to seize your property. In an act of sheer desperation, you are forced to leave the heavily regulated, relatively safe environment of the A lenders, and you descend into the shadow banking system. You enter the world of B lenders, alternative mortgage investment corporations, and private lenders. This is where the financial slaughter truly begins. Private lenders do not care about your T4. They do not care about your notice of assessment or your debt service ratios. Private lenders only care about one thing, the raw equity in your property. They are willing to lend you the money to pay off the major bank and save your home from immediate foreclosure. But the price of this rescue is absolute extortion, because you are a distressed borrower who has been rejected by the prime system. And the private lender knows you have zero leverage. They will not offer you a 5% interest rate. They will offer you 10, 12, or even 15% interest on a 1-year interest-only term. On top of this crippling interest rate, they will charge you a lender's fee just for the privilege of borrowing their money, which is typically 2 to 3% of the total loan amount, and because you have to use a specialized mortgage broker to access this shadow money. But the broker will charge you another 1 to 2% fee. Let us apply this to the family who needs to renew a $600,000 mortgage. To get rescued by a private lender, they are instantly hit with an $18,000 lender fee and a $12,000 broker fee. $30,000 in pure fees are capitalized and added directly to the principal of their loan before they even make their first payment. Then their mortgage balance instantly jumps from $600,000 to $630,000, and their new monthly payment, calculated at 12% interest, skyrockets to over $6,000 a month for interest only. They are paying more than double what they used to pay, and not a single penny is going towards paying down the actual debt. This is not a rescue, it is a financial hostage situation. The private lender knows that a family with a reduced income cannot afford a $6,000 monthly payment. They know the family will inevitably default within a few months, but the private lender does not care. They engineered the loan specifically so the family would fail. Because when the family misses a payment on the private mortgage, the private lender executes a swift, brutal power of sale. They seize the home, sell it on the open market, take back their inflated principal, and collect all the massive penalty fees and legal costs from the proceeds and leave the family with absolutely nothing. The major bank used the T4 trap to push the vulnerable homeowner off the cliff, and the shadow banking system was waiting at the bottom to strip the corpse. We must ask ourselves a very dark question. Why are the major Canadian banks doing this? Why are they proactively forcing loyal, paying customers into the meat grinder of the private lending market? The narrative sold to the public is that the banks are just following prudent regulatory guidelines. But the truth, hidden deep within the balance sheets, is far more cynical. The Canadian banks are acutely aware that the national real estate market is resting on a foundation of sand. They see the massive overvaluation. They see the rising unemployment. They know that a significant correction, a crash, is no longer a remote possibility. It is a mathematical inevitability. When a housing crash occurs, the banks are left holding the bag on billions of dollars of toxic debt. If property values plummet by 30% and hundreds of thousands of homeowners default, the banks will take catastrophic losses that could threaten their own solvency and obliterate their stock prices. To protect their shareholders, the banks are executing a preemptive strike, and they are using the T4 trap to actively identify the weakest borrowers in their herd, the ones most likely to default when the recession truly hits, and they are systematically purging them from the loan books right now, while property values are still relatively high. By forcing you to find a private lender, the major bank gets their money back in full today. They clear the risk off their ledger. They transfer the toxic asset to the shadow banking sector. The major bank protects its pristine balance sheet and ensures it can report record profits for another quarter, while you and your family are thrown to the wolves. They are sacrificing the middle class to fortify the banking cartel. The implementation of the T4 trap is also exposing the massive scale of the Brampton loan epidemic. For years, the banking industry turned a blind eye to the cottage industry of fraudulent mortgage brokers who were altering PDFs, fabricating employment records, and creating fake T4 slips to get unqualified buyers into the market. The banks enjoyed the massive volume of new mortgages and the resulting bonuses. But now, the music has stopped. As the banks initiate these aggressive income audits at renewal, the borrowers who used fake documents 5 years ago are trapped. They cannot produce a legitimate Notice of Assessment from the CRA to match the fabricated income they declared on their original application. And when the bank catches this discrepancy during the renewal audit, the consequences are immediate and severe. It is not just a non-renewal. The bank flags the file for mortgage fraud. They report the borrower to the national credit bureaus, placing a devastating black mark on their credit profile that will prevent them from borrowing money from any legitimate institution for nearly a decade. The bank calls the loan immediately, forcing the fraudulent buyer into a panic sale or a brutal foreclosure. This systematic unwinding of fraudulent loans is adding massive inventory to the housing market, driving prices down further and accelerating the panic selling we documented in previous investigations. But the tragedy of the T4 trap is that it does not distinguish between the fraudsters and the genuine, hard-working Canadians who simply fell on hard times. The algorithm does not have empathy. It does not care that you were a loyal employee for 20 years before your company restructured. It does not care that you took a lower-paying job to be closer to your sick parents. It does not care that you have skipped vacations, canceled subscriptions, and sold your second car just to make sure the bank got paid every single month. To the algorithm, you are just a cell on a spreadsheet. You are a debt service ratio. And if that ratio flashes red, your financial execution is scheduled automatically. If you are listening to this and your mortgage is coming up for renewal in the next 12 to 24 months, you must listen to me very carefully. You are entering a war zone, and your own bank is the enemy. You can no longer assume that your past loyalty will guarantee your future security. You must prepare your defenses immediately. First, do not make any sudden career moves. This is the absolute worst time in Canadian history to quit your stable job to start a risky business, or to take a pay cut for a lifestyle change. The bank demands stability. They want to see a solid, continuous T4 and unbroken pay stubs. If you must change jobs, ensure there is absolutely no gap in employment and that your new salary is equal to or higher than your old one. Second, if you have experienced a drop in household income, you must proactively attack your debt before the bank audits you. The algorithm looks at your total debt service ratio, which includes your credit cards, car loans, and lines of credit. If your income has fallen, the only way to keep your ratio within the acceptable limits is to drastically reduce your outside debt. Sell the financed car and buy a cheap used one for cash. Liquidate non-essential assets to pay down the credit card balances to zero. You must present the leanest financial profile possible when the underwriter puts you under the microscope. Third, Do not wait for the renewal letter to arrive in the mail before you take action. The moment you are 6 months away from your renewal date, you need to engage an independent, highly rated mortgage broker. Do not rely exclusively on the bank branch employee. The branch employee works for the bank. Their job is to protect the bank's interests, not yours. And an independent broker can analyze your current T4s, your notice of assessment, and your credit report. They can run the exact same stress test algorithms the banks use. If the broker sees that you are going to fail the income test with your current lender, they have the time to discreetly shop your file to other lenders, credit unions, or secondary institutions before your primary bank officially rejects you and damages your credit profile. Finally, you must mentally prepare for the reality that the Canadian banking system is no longer a partner in your wealth creation. They are a predatory mechanism designed to extract interest when times are good and to aggressively seize collateral when times are bad. The illusion of the friendly neighborhood bank manager is dead. You are dealing with a cold, calculated machine that is actively seeking to purge vulnerabilities from its system. And they have decided that the struggling Canadian homeowner is the ultimate vulnerability. The rules of the game have been violently rewritten. The automatic renewals are gone. The era of blind faith is over. The banks have activated the T4 trap, and they are using it to sweep the collateral damage of a broken economy under the rug of the shadow banking system. They are protecting their billions while you fight to protect your living room. Subscribe to Canada Property Watch. We are exposing the fine print. We are tracking the algorithms. We are giving you the unvarnished, terrifying truth about the financial machinery operating behind the closed doors of Bay Street. The mainstream media will tell you the banking system is resilient. They won't tell you that the resilience is being built on the engineered ruins of the middle class. Do not get caught in the purge. Gather your documents, lower your debt, and prepare for the audit. We will see you in the next investigation.